Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for exercise 1630. This is the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so the first thing we're talking about are stock appreciation rights. And I don't want to call it SARs because that means something else, but over here, and I'll put these links. I did this for the last exercise, but this is a really, this is going to give you some really good information about what stock appreciation rights are. And especially if you have a limited ability to go through and to award stock, you can give executives or those in your company the ability to appreciate in the value of the company without actually giving them shares. So there's a lot of different reasons for going through and doing it, but let's go over here to our particular question. So Capulet Company establishes a stock appreciation rights program that entitles its new president, Ben Davis, to receive cash for the difference between the market price of the stock and a pre-established price of 30. On December 31st, 2016, on 30,000 SARs. The date of grant is December 31st, and the required employment service period is for 4 years. President Davis exercised all 20 SARs in 2022. The fair value of the SAR is estimated to be 6, 9, 15, and the like. Okay, so it's a 4-year service period. One of the things we're going to assume in this question is that the vesting period is 25% per year. That can change, as I mentioned in the last problem or the last question. If we were doing this for Amazon, Amazon typically has a loaded vesting, which is going to happen later on in the period. So we're going to start here at 12/31/17. I'll try to make this a little bit bigger. By the way, if you're looking for this free version of this textbook, there's a great website called zlibrary.org. And if I type in intermediate accounting, what you'll find is right over here, this is the textbook that I use. You can download it for free. So great website. And, obviously we want to be thankful to Wiley for allowing them to put that up there. Okay. So my stock appreciation rights is going to be 30,000. Okay. So this is going to be 30,000. And the value of that stock appreciation right is going to be, the fair value of the SAR is estimated $6 on December 31st, 2017. And so my total value, or the total amount, is going to be $180,000. Now, as of 12/31/17, the amount of the vesting that's happening is only vested in one of the 4 years. So over here, what we're going to say is that my liability under stock appreciation rights is going to be 180,000 times 25%. Okay, so that's going to be my liability in this under the stock appreciation right. And so my compensation expense is going to be that same amount. So let's just kind of make some T accounts for the rule of Ingrid, who really appreciates the T accounts. So right over here, you've got liability under stock appreciation rights. And what you're going to do over here is that this is going to be 45,000 on 12/31/17. And so what I'm going to be going through over here and debiting is going to be compensation expense. And this is going to be for $45,000 on 12/31/17. So my journal entry to record this is on 12/31/17 will be a debit to compensation expense, credit liability under stock appreciation rights, 45,000, and we'd have a date. Okay, so that's what we're going to go through ahead and do over here. So let's take now a look at the next year. So on 12/31/18, stock appreciation rights have not changed. The value is estimated to be $9 now. So my total amount is going to be $270,000. But at this point in time, my liability is not that full amount. Why is that? It's because the employee has not been working the full amount of the time to vest. So the amount of my liability is going to be half of this. So right over here, this is going to be 270,000 times 50%. And so what we're going to do is we're going to say that, well, the liability over here should be 135,000. So the amount of the expense I'm going to recognize is going to be the difference between these two over here, or it's going to be 90,000. And so my compensation expense for 12/31/18 is going to be 90,000. Okay. All right. So the next one over here on 12/31/19, stock appreciation rights have not changed, but now my value is at 15. So the total amount of the value of the stock appreciation rights is 450,000, but we're only in year 3 of 4. So now I'm going to multiply this over here by 75%. So this is going to be 450,000 times 75%. So the amount for my liability under the stock appreciation rights, this is going to be 337,500 on 12/31/19. So the balance I'm going to need to get from here to here is going to be 202,500. Okay, so my comp expense is right over here. And if we add up the comp expense, it should equal actually the liability under the stock appreciation, right? So this is what we're always going to be going through and balancing to. So we've got 12/31/20. My stock appreciation rights are still 30,000. And the value of this now is $6. So my total amount over here is going to be 180,000. But my liability is going to be 180,000 in total because I've fully vested. So over here, so if my liability under the stock appreciation right is at 180 on 12/31/20, what I'm going to actually need to go through and do is I'm going to need to show a debit under my liability in order to go through and balance, right? So 337 minus 157 is 180. So this is going to be amount of the compensation expense. This is how I'm going to go through and record it for 2020. Now, again, I know it looks strange that we're going through and we are debiting we're going to be crediting compensation expense, but because we are in the service period, essentially what's happening is that because we're in that service period, we can go ahead and credit compensation expense. Okay, so I'll kind of highlight this just to be a little bit different right over here. Okay, so the next thing it tells us over here is that now once the employee has vested in their stock appreciation rights, what they can, it really depends on what's triggering them to kind of go through and do they have to exercise within a certain period of time. So if we look at this a little bit more carefully, prepare a 5-year schedule. So the service period is 4 years. So they have fully vested. Okay. Part employment period is 7 years. So what's going to happen at this point is that for 12/31/21, What we're now going to go through and do is we still have the stock appreciation rights at 30,000, but the value of the stock is now at 18. So the total value over here is 540,000. They have fully vested in this stock. So the liability is going to be the full amount. So this is going to be 540,000 times 100%. So there's no trigger clause for this president to compel him to go through and to do the options or to take the stock appreciation right. So what we're going to do is we're just going to keep going and recording the compensation expense. So the compensation expense for 12/31/21, or if that year ended, is basically going to be 360,000. And if I put this up here, right over here at 360, so that's kind of where we are. And again, if I add up all the compensation expense taken to date, this needs to equal the amount of the liability under the stock appreciation right. So it's asking us to do journal entries for comp expense in 2017. So here's my 5-year schedule. And it's asking us to do compensation expense for 2017, 2018, 2020, and 2021. So what we're going to do here is we'll just go ahead and kind of, so this is going to be 12/31/20. Remember, this is the year that we had the debit to the liability under the stock appreciation right. And this is going to be 12/31/21. You may want to call this something else because you're not really recording expense to adjust liability under stock appreciation right. And then over here, you've got compensation expense liability for this last year. This is going to be for 360 and then for 360. Now, the one thing is, again, is that with this question, they're not talking about like how long that person has to go through and to do it. So we would just, if this was a 10-year, we would just keep going. So you would just go every year and they're fully vested. So we're going to be multiplying all those values by 100% going forward. So I want to thank you for joining me here today. Please don't forget to like and subscribe. If you'd like to see other solutions to different questions in this textbook, feel free to ask in the comments. Hopefully you found this enjoyable. I know I did, and hopefully it put you right to sleep. So anyways, have a great rest of your day, and I look forward to seeing you on the next video. Have a good one.